Welcome back. Now let's take a look at some stocks that are in focus today. HUL has cut prices for some products in its soaps portfolio. Mangalam, tell us what the company had to tell CNBC about the rationale behind this move.
Well, for starters, yesterday there was news doing rounds on wires that they've cut prices to the tune of 25 to 30%. But it seems like that would have been on selected products of the 10 variants of Lifebuoy that they have. They would have cut it by 30% on one of or two of those variants. And that would perhaps also be on a lower price. A 3 rupee soap becoming 2 rupees would be a 30% cut, as against a 10 rupee soap becoming a 9 rupee soap, which would be just a 10% cut. So the company has responded to us and said they've taken price reductions of around 4 to 6% in their Lux and Lifebuoy portfolio. And that's primarily the sum and substance of it all, not 25-30%. There may be cuts which are higher on certain packs, but definitely not to the tune of 25 to 30% across the portfolio. And the company has a rationale for that. The first one is the fact that raw material prices, they're expected to remain benign in the near term, and they want to pass these benefits to the consumer, especially given the fact that the consumer sentiment is fairly weak. So lower prices would always aid that. And it's not something that the company has done out of the blue. It is something that they had told the analysts and the street after their first quarter conference call as well, where they said that personal wash, particularly the popular segment, the likes of Lifebuoy and Lux, witnessed some muted delivery, and they have taken some bit of price action in that itself, especially soap. What is the benefit of a price cut? The first one, of course, is that it gives you a volume push. Secondly, it gives you market share gains. Thirdly, there could be a bit of an impact on the margins, but how much of that impact it would be is something we'll have to watch out for, given the raw material prices are benign. The stock was near record high, so maybe some bit of profit taking that took place yesterday. Let's see how it pans out today. My sense is that maybe it would see some green. More importantly, I'll watch out for Godrej Consumer, because this is a competitor of Hindustan Unilever, and when your competitor cuts prices, you are either compelled to cut prices or lose some market share. They generate 20% of their revenues from the soap portfolio. Let's see how that pans out.
All right, Mangalam, thanks for that. It'll be interesting to see how Godrej Consumer and HUL both fare today. But shifting focus to another important story now. The Union Cabinet is all set to meet today, and we learn that a slew of FDI reform proposals are on the anvil. Remember, Nirmala Sitharaman, during her budget speech, had laid out the government's intent to carry out FDI reforms in single-brand retail, media, aviation, animation, as well as games. Ritu Parnab Bhuyan joins us now with more. Ritu, what have you picked up?
We understand that in the evening today there is a cabinet meeting where a package on FDI reforms is likely to be considered. One of the sectors where FDI-related announcements are likely to be made is in the animation as well as gaming and computer graphics, etc. Basically, certain sections of multimedia where the government will clarify that FDI will be allowed. That is one segment. Secondly, contract manufacturing. Now, remember that in manufacturing, 100% FDI is allowed, but many foreign companies wanted to have some clarity on contract manufacturing. So that clarity is also likely to be given, wherein the government is likely to say that even in contract manufacturing, 100% FDI is likely will be allowed. That is the second point in the FDI agenda that we understand will be taken up by the cabinet. And thirdly, in single brand retail, there are domestic sourcing norms. From what we understand, that the cabinet is likely to take up a proposal wherein these domestic sourcing norms are likely to be relaxed. For example, you have, as of now, these single brand retail companies adjust their global sourcing against their domestic sourcing norms for a period of 5 years. So that there will be some relaxation to that. Not only that, even online sales will be permitted before the brick and mortar stores are up as far as single brand retail sector is concerned. So these are the proposals which are likely to be taken up by the cabinet today when it meets in the evening.
All right, Ritu, thanks a lot for that. So definitely we'll keep an eye out on these things. Remember, a lot of them were announced in the budget. Implementation is something we'll be watching out for. But the Reserve Bank of India has released the report on the Jalan panel review of the Economic Capital Framework. And Lata's here with the fine print. Lata.
The Jalan recommendations, actually the bulk of it was already put out as a press release by the Reserve Bank 2 days back. Basically, the panel says that RBI's capital has two sides to it, or two components: the revaluation reserve and the contingency reserves, which contingency reserves are monies, it's more like retained earnings of a company, which has been put aside over the last several years. Now, revaluation reserves should not be cannot be distributed as capital, because it is not a realized gain, and therefore that should not be even counted when you're looking at the RBI's capital. It is subject to market price. Tomorrow, if the price of gold crashes, the revaluation reserve will shrink. So that can't be taken away as capital. Because it is subject to market risk, set aside revaluation reserve, only treat the contingency reserves as capital, and over there, to measure how much of capital you need, contingency reserves you need to keep in your capital, the Reserve Bank says, the panel says that it has adopted the expected shortfall method rather than the stressed value at risk method, which was employed so far. That is a Maligram committee hand down. So the expected shortfall method, they want the RBI to use the 99.5% confidence level. Until now, the practice is to use 99% confidence level. So they've been a little more conservative. According to them, therefore, contingency reserves should be between 5.5% to 6.5% of the total balance sheet of RBI. If you took that calculation, the panel says that the excess reserves at the lower bound, at the upper bound would have been 26,280 crores. At the upper bound, it would have been 62,456 crores. This is what you can consider excess, depending on whether you take 6.5% of balance sheet as contingency or 5.5%. As we now know, the Reserve Bank board had chosen a middle number. They didn't take 65,500 odd crores nor 26,000. They chose 52,630 as the excess capital, and they have already transferred it to government. The other two or three important recommendations of the Jalan committee: one, they say that the RBI's financial year should be aligned with the government, otherwise it's creating too much confusion as to which year of RBI's money is going into which year of the government's money. They also say that interim dividend should not become a habit. In the last 2 years, the government has been demanding, and the RBI has forced to give. Interim dividend should be used in times of exceptional crisis. And finally, the Jalan panel says that you should review their recommendations every 5 years, because accounting standards change, reality changes. So I think that's a very wise caveat as well that they have put in.
All right, Lata, thanks a lot for taking us through the fine print of that report. But back to some stocks that we are going to be focusing on today. Natco Pharma will be in focus as CNBC-TV18 has accessed the US FDA's observations issued to its Telangana unit, which was inspected from August 5th to 9th. Sonal Bhutra joins in now to tell us more. Sonal, some bad news for Natco?
Oh, absolutely, Pavitra. It's a bad news because it's an important plant. It's the API plant, and that's why I expect the stock to be in red today. So Ekta has been able to access the observations in the US FDA form, which says that responsibilities with respect to the quality control were not followed, the utensils were not cleaned properly, and the employees which were involved in the manufacturing, they were not properly trained. Apart from that, it also says that appropriate controls are not exercised over computers, and lab controls do not include appropriate specifications and appropriate standards. So while these do not look like data integrity issues, still the expectation is the stock should be in the red because it is an important plant. Apart from that, the observations really depend on what kind of response the company really goes ahead and gives to the US FDA. But for today, it definitely is a dampener for the stock. Back to you.
All right, thanks a lot for that. At the same time, wishing you a very, very happy birthday. May you have a good year going ahead.
Thanks.